Welcome back, traders and investors. We have Chris Benedict on the line, and he is Vice President of DataLend. Chris, how you doing today?
Doing very well, Joel and Dennis. Thanks very much for having me back on the show. I appreciate it.
Okay. Tell us a little bit first about your education and your market background and how you ended up doing what you're doing.
Sure. I started to get involved in securities back when I was in college. I thought it was very interesting, Federal Reserve and the equities markets, and I thought that'd be a really interesting career to pursue. So I got a job trading for Yamaichi International back in the late 90s, and that was sort of a buy-side shop where we were controlling order flow out of Japan and maybe shopping it to hedge funds or taking the other side of their orders. After that, I was working as a NASDAQ market maker at National Discount Brokers for a few years. Was working also at, after that, Pershing, when it was owned by Credit Suisse in the late 90s, early 2000. And then after that, I went back to school and went to Boston University to earn my MBA with a concentration in finance and a master's in information systems. Upon graduation, I got a job working at the wealth management consulting area of Bearing Point. And then back in 2005, I joined DataLend, which has been a great experience. And then, as you might know, we started working on DataLend, which is the market data arm of our securities finance platform. Back in 2011, we went live in January of 2013, and since then we've got about 47 clients globally on the platform, with an on-loan balance of about $1.8 trillion a day, global inventory of around $12 trillion a day, and we're covering about 42,000 unique securities globally. So really interesting place to be in the securities finance area.
It sure is. So, when you're talking about shorting stocks, I mean, if you're doing day trading or whatever, you really don't have to worry too much about lending rates. But could you just, if people are gonna, short stocks over the long term, they're gonna have to, pay a rate to have the stock to short to borrow the stock. Could you just give us a rundown on how lending rates are calculated?
Sure, it's not an exact science. It's really more of an art form. But we can. I've got sort of two examples that we can use, and one is General Electric, and that's an example that's very easy to short because it's got 10 billion shares outstanding. It's a very liquid name. It's not particularly volatile. Usually trades $26 a share, and has been in that range for a while. Low utilization, very low short interest. So that's a name where if an investor wanted to borrow shares to short, it would be very easy for them to do. There's a lot of supply out there, and as a result, fees are going to be very low, maybe 10 basis points or so. But another example would be an example of a very high demand security right now is GoPro. It's been a very high IPO since they floated about last month. There are only about 17.8 million shares outstanding right now, and it trades in a very wide range, anywhere from maybe $30 at the low to $50 at the high right now. So there's a lot of range there. And because it's so volatile and because there's such limited inventory, fees are going to be very high to borrow that. So if for example, you're an institutional investor and you wanted to short maybe $100,000 worth of GoPro today, that would cost you about $170 in financing each day. So that's going to add up after a while. That's going to be about, if you were going to short that for an entire year, that would be at current rates about $62,000 to short that, a $100,000 position.
Wow. So I mean, at that rate, you would just need the stock to get absolutely devastated in order to get a return on that investment if you're paying that kind of a loan rate.
Yeah, you'd have to factor that into your models, absolutely. So that's something, and rates change a lot. So GoPro, for example, it's a really wild swing in terms of the cash markets and the securities finance market. So you got a cash market maybe that can run 5 or 6 or 7 points a day to the upside or downside. It's the same thing in terms of the fees to borrow. So the fees can climb by a few thousand basis points or decrease by a few thousand basis points. So there's volatility in both aspects of that particular stock.
Okay. So you wanted to talk about short interest securities lendings and various indexes such as the S&P 500 and the Russell 2000. Now, in the S&P 500, you have 10 stocks basically making up about 20% of the index. Are those 10 stocks? I mean, are they pretty liquid and pretty easy to borrow, and then the ones going farther on down the line, the more you get away from the liquidity and the volume, the higher the rates go.
Yeah, that's exactly right. So you've got a stock like Apple, which I think makes up 3% of the S&P 500. That's very liquid right now. And in that case, unless there's earnings or something, there's an event-driven reason why it'd be hard to borrow. It's gonna be pretty easy to borrow, and the utilization on that is quite low. Fees to borrow are very low. So when we're looking at all these indexes. We're looking at the iShares Russell 2000 and the S&P 500. We did take the weighting into consideration when we're looking at our metrics. And looking at the S&P 500, it's pretty interesting. It seems like there's a degree of complacency in the market right now from the S&P 500 perspective, because we looked at the on-loan balances at the end of last year. Basically looking through May, looking through the sell-off that happened on July 31st to August 1st, and really not a big change there. We had about 199 billion on loan from the constituents of the S&P 500 at the end of December. It's now about 202 billion. It came down a little bit after the sell-off that we had a couple weeks ago, but that's really a very small increase. That's a 2% increase in the on-loan value for the constituents of the S&P 500. So that's kind of interesting. It just seems like the shorts are not really gearing up. When you're looking at the S&P 500, nobody's really gearing up for a big correction that people have been talking about. There are a couple of exceptions. So if we take a look at the energy sector actually did increase substantially in the S&P 500 from 13 billion to about 16.8 billion. And I think two standouts there in the energy sector are Transocean, which is ticker RIG. That hasn't really participated in the rally at all. It's fairly highly utilized right now. It's 70%. So there's a pretty big position on right now for that particular stock. Also, Diamond Offshore Drilling is another one in the energy sector that the shorts seem to be taking a look at right now. It's high utilization, fairly high fees as well. So I think those two stocks. I don't know. I don't have their market shares outstanding, but it seems like they are sort of aberrations, if you will, in the energy sector for the S&P 500, and that's what's driving the on-loan value there.
And the rally up, kind of like the last leg of the rally, was kind of led by the energy sector, and now not only have we gotten a pullback from the highs in those stocks, but now from what you're saying, increased interest on the short side here. Do you think this has any implications for the overall market?
It's really hard to say. That's a great question, and I think that you probably have people with PhDs and huge spreadsheets running quants to sort of figure that one out. I really wish I could say. It just seems to me that those two securities in the energy sector for the S&P 500 were sort of outliers or aberrations, if you will, because the majority of that sector in the S&P 500 trades fairly what we call GC, or very low rates, and fairly low utilization as well.
Any other hot sectors or hot securities now that are demanding pretty? You mentioned GoPro. Are there any other sectors or any other securities that you can mention that you would say that things have picked up in?
I would say the utilities for the S&P 500 has increased. I'm trying to think of specific securities there, but it looks like just in general, you had utilities for the S&P 500 increase from about 10 billion to about 13 billion, so that's about a 30% increase. And then healthcare, some biotechs in there have been pretty warm, and Quest Diagnostics in healthcare has been particularly we've seen an increased utilization in Quest Diagnostics. So that increased from about 22 billion to about 24 billion for the S&P 500. But I think that we're seeing a clearer picture. We're talking about supply and demand and how liquid some of the names in the S&P 500 are versus the Russell 2000. I think we're seeing maybe more of a pattern in the Russell 2000, both in terms of on-loan values, fees, and utilization as well. So the Russell 2000 started the year off at about 97 billion on loan, and that's increased to about 114 billion today. So that's a substantial increase. That's about an 18% uptick in the on-loan value. We also saw fees jump as well. So on aggregate, weighted for each one of these components in the Russell 2000, we had a volume-weighted average fee to borrow of about 120 basis points. That has increased by almost 20% to 142 basis points. So it looks like, based on volume and fees, it seems like the shorts are looking at the smaller cap names in the Russell 2000 And I don't know if they're anticipating correction anytime soon, but it seems like the selling pressure is mounting in the Russell versus the S&P 500.
And that peaked a little bit ahead of the market. That peaked on July 1st, and has kind of been in a down channel. One of our guests, Nick Shaheen, has been talking about that. The S&P peaked later in July, so that'll be an interesting trend to follow. Do you notice any discernible trends in data lens inventories ahead of earnings season? Did people just kind of like say, you know what, I've had my short on, but I'm not going to roll the dice going into earnings season, or do people, or is there an increase that people are going to take shots on good earnings or bad earnings?
It's really stock dependent. So I think that we don't necessarily see overall volumes across indexes or the market as a whole vacillate a lot before earnings seasons, but we will see examples where shorts might get ahead of earnings and something. So I think we were talking last time I was on, we were talking about Twitter a bit,
Yeah.
and Twitter had earnings come out. They weren't so great back in April, and I think that people were very disappointed, or investors were very disappointed at that point in time in the user growth that was disclosed in the numbers for Twitter. And so we definitely saw Twitter in a lot of demand amongst the short community. So that was over 90% utilized. Fees were very, very hot right before earnings. And then earnings came out. You also had the lockup expiration. The stock kind of cratered and I think it hit support around $30 and has rebounded really nicely since then. And since then, we've seen the shorts sort of go away. So it looks like the second round of earnings that recently came out, the shorts really weren't interested and weren't positioning themselves before those earnings. So, to answer your question, it's very stock specific. We don't necessarily see trends in the overall market before earnings. It's really individual securities that we can see trends.
August typically is a weak month for the overall markets. August and September, of course, we've had a few doozies in October as well. But
Yeah.
do you see any seasonality patterns in terms of of shorting or increases in your business?
Yeah, we do see some. Usually in December, we see the shorts closing their positions because they don't necessarily want to go into the new year or short anything. So we'll see a drop in the on-loan values, and we'll see a decrease in our trading volume on our trading platforms. Historically, we've also seen the same thing during the summer, but this summer has been a little bit different. We have, like I've noticed, we've seen an increase in the on-loan for the S&P 500 and a bigger one for the Russell 2000. But in terms of the trading volumes that our platform is doing, we're breaking records right now in terms of the number of tickets that we're writing and in terms of the notional value. So that's kind of interesting. We don't normally see that during the summer. So again, that might be another pattern. Maybe shorts are gearing up for a little bit of a dip or some kind of correction. So usually the summer months, it's a little bit slow, but this year it doesn't seem to be the case. Another earnings or another seasonal event that doesn't happen in the U.S., so I'm not really going to go into it too much, but we call it dividend season in Europe, and that's very popular in Europe, where basically securities lending increases substantially in France, Germany, the U.K., from basically starting around April to about July. But that's a very specific trade. It's kind of I don't know if it's proper to talk about it for your audience today.
Okay, and just going into a little bit, just about your company here, DataLend. Are you just dealing with institutions, or do you also have large investors that go through you, or what kind of credibility do you have to be a customer of DataLend?
Yeah, we're institutional only, so we're basically supporting what we call the wholesale market here. So we've got broker dealers, which would be some of the biggest broker dealers on the street rather, such as Credit Suisse, UBS, Morgan Stanley, Goldman, and they are borrowing from agent lenders, some of the biggest banks on the street, such as State Street, Northern Trust, BlackRock, and basically that's what we're dealing with. We don't deal with hedge funds. We don't have any insight into what hedge funds are doing really, because we're not getting any data from them, and we don't have any insight really as to what the beneficial owners or the underlying clients of these agent lenders are doing, and that would be mutual funds, pension plans, et cetera. But it's a give to get model. So basically, we're taking the aggregate data from our clients and basically extrapolating what the fees are, what the on loan balance is for each security, and aggregating that data every day. So it's really just the wholesale, what we call the wholesale environment. There's really nothing in terms of the retail investor space really, or hedge funds, et cetera.
Okay, and then just to close things out here, you said something about your inventory or the amount that you had loaned out as far as total value. Is it at extremely high levels for August? How does this compare with other time periods? I'm not sure how long you've been at the company, so it would be great if you were there in 2008, 2009,
Yeah.
but
Well, yeah, back then we did have, our transaction volumes were up certainly back then. And here, I think right now we're seeing, in terms of the on loan balances, it's a little bit higher than normal, I think, from this time last year. The fees maybe across these indexes also look a little bit higher as well. And certainly, like I said, our trading volume is very high too. So it could be that, like I said, the shorts might be gearing up for something in the fall. Right now, we did have that correction, well, not a correction, but a sell-off in July 31st into August 1st, and maybe that's a taste of things to come for the fall, September, October.
Okay, great. We've had Chris Benedict on, and he's vice president of DataLend, talking about the securities lending industry and all the different factors that go into calculating the rates. Chris, thanks a lot for coming on. It's interesting to get your perspective on the markets, much different than a lot of our other guests. So thanks again, and we hope to have you on again soon.
Hey, my pleasure. Thanks for having me.
Okay.